Chapter 11, Corporate Reporting and Analysis. Nature of a corporation. What is a corporation? A corporation is an entity created by law that is separate from its owners. It has many of the same rights and privileges as an individual person. Owners of corporations are called stockholders. Corporations can be separated into two main types. A privately held corporation does not offer stock for public sale. It usually has just a few stockholders. A publicly held corporation offers its stock for public sale and can have thousands of stockholders. So public sale usually refers to the issuance of stock and trading on an organized stock market. So a corporation is a specific type of business structure. It is its own legal entity separate from its owners, and it offers a couple of advantages that we'll talk about. The stockholders' role. So stockholders are the individuals who invest funds into a corporation through the purchase of stock. The funds that they invest allow the corporation to continue operations or maybe to finance a special project to expand business. The stockholders may receive dividends as part of their investment. So at a stated time, the corporation might issue a dividend to its investors or distribute some of that profit to its investors as a dividend, but that is not required. So a stockholder can invest in the company, own stock, and never get a dividend. Corporation is not required to give dividends. So the ultimate control of a corporation rests with the stockholders. The stockholders, who are the owners, then elect the board of directors. The board of directors hire the executive officers like the CEO, CFO, and then the officers hire the other employees as needed. So employees, officers, and members of the board of directors may also be owners of the corporation, but it starts with the stockholders and moves down from there in terms of the hierarchy of power. Corporations have unique characteristics that offer advantages and disadvantages. So these are some of the advantages. First of all, a corporation has a separate legal existence, so it operates with the same rights and responsibilities of an individual person. It's its own entity. It takes actions through its own agents, who are the officers and managers. Continuous life. This means that a corporation's life is indefinite. It's not tied to the physical lives of its owners. So if a stockholder passes away, that does not mean that the corporation is dissolved or anything like that. Corporation is able to raise large amounts of capital through issuing stock. Ownership rights are easily transferable. Stock can be sold between people to change ownership rights over to someone else. And it has limited liability, which means that the stockholders are not responsible for the debts or legal actions of the corporation. Disadvantages of the corporate form. So ownership is separate from management. We mentioned that as an advantage, but there is also a disadvantage, a downside to that. What that means is that the owners then have to rely on someone else to manage day-to-day operations. So if you look at the stockholders as the owners, they are not the day-to-day managers of the corporation. So the stockholders or owners have to rely on management to run the corporation. Double taxation is a disadvantage. So corporations are subject to the same property and payroll taxes as other business entities, so like as sole proprietorships, partnerships, but federal and state income tax for a corporate entity, they are assessed. So federal and state income taxes are assessed on corporate income. So whereas a partnership or a proprietorship do not have to pay taxes at the entity level, a corporation does. Then, even after a corporation has already been taxed on its income at the business level, if it declares dividends to the stockholders and the stockholders receive some of that income as a distribution, Then the stockholders themselves, when they get the dividend, they have to pay taxes on those dividends at their personal level as well. So that is referred to as double taxation. And then there are also additional regulations. So a corporation has to meet requirements of their state's incorporation laws, and other types of entities can avoid those. So proprietorships and partnerships don't have to worry as much about those regulations or regulatory costs. Forming a corporation. It's not very hard to just file the initial paperwork to form a corporation. There's just an application that has to be submitted at the state level. State incorporation laws differ. So that's why you may have noticed that a lot of corporations are incorporated in the state of Delaware because Delaware has more favorable corporate laws. So even if the company actually operates in the state of Alabama, it's possible that they have incorporated in Delaware to take advantage of some of those favorable laws. So the state grants a charter to the incorporators, and it's called the Articles of Incorporation. And then after that, corporate management and the board of directors are responsible for preparing bylaws, which are the rules and procedures for the corporation. Costs incurred in organizing a corporation. So just like with any other business structure, there are costs involved in getting the corporation started. So of course there's going to be legal fees, state incorporation fees, promotional costs. Then there are also taxes, sometimes promotional costs. So all of these are considered organizational expenses, and as they are incurred, they're debited to the expense account called organizational expenses.